It's a pleasure to be here, coming from the Netherlands, the first time to Australia, and I already noticed some differences between your country and mine. First is the weather. When we departed from the Netherlands 3 days ago, it was freezing cold, and we came here and the weather is fine, and you are complaining that it's not that good. Second, distances. This country is huge. If I'm in Utrecht, where I'm based in the Netherlands, and it takes 3 hours and travel in any direction, I'm across the border of my country. On bicycle, that is. And finally, I heard about the volatility of the climate in Australia. We don't have much volatility in the climate in the Netherlands. It usually is wet. The only volatility we have is the degree of wetness. So it's quite a different experience here. What I would like to do in the next half an hour is very briefly the world economy. Paul already touched upon some topics, so I can go quickly through some topics about the world economy. And then we'll try to shed some light on Europe. Because if you read the newspapers in England or in Australia, in the English-speaking world, then the bottom line message the press gives you is, in the Eurozone, they are messing it up. And they are right. They are messing things up. But the conclusion many analysts in the UK draw, that the Eurozone is not stable at all, and in the end is a weak part of the world economy, is the wrong conclusion. I have a strong conviction that the Euro will be with us, will be one of the major currencies, and the chances of the UK leaving the European Union are much smaller than the chances of the UK entering the Eurozone, although I'm not sure whether I will see it alive. This should work. Yes, there it is. Here you see more or less summarized what Paul already told us. You see the world economy, which is the orange line. There's a peak here, recession there, a recovery, but it's very uneven. You see here the bottom line is that the developed economies, OECD countries, are lagging behind, and it's the emerging markets that are really doing relatively well. And within the developed economies, of course, it's the Eurozone which is doing the worst job here. And if we look at the outlook in the short term, we think at best we will have a slow recovery, a really slow recovery and quite a bumpy recovery. In the European environment, we will see that the European Central Bank, which actually is the only European institution that really can react speedily and effectively to financial market pressures, is successful in keeping the whole thing together, but in the course of this year we need more political integration, better cooperation between countries for the whole thing to stabilize. In the United States we see two things. First, that the economy is doing relatively well. There is some recovery in the housing market, in production, but at the same time there are some structural problems there. One is that it's a difficult country to manage if the two major parties refuse to cooperate. So the run from the fiscal crisis, the fiscal cliff, to the debt ceiling, to the sequester, and again, they make a crisis of every opportunity they face, which actually is bad news. And more structurally, one of the problems with the US is that they spend more than they produce. And they have done this for over 30 years now. It's a heavily indebted country, but all these debts are in US dollars. As I'll explain later, I'm not very optimistic about the future of the exchange rate of the US dollar. And finally, China, very briefly, it's impressive what China has done. When they started their reforms at the end of the 1970s, China's exports were less than half the exports of the Netherlands. And today, China is the largest exporting country in the world. So that's really impressive what they did. The problem is that all this growth has been export-led. And increasingly, you see huge surpluses in China, large deficits in trading partners. They don't like that kind of stuff. So there's upwards pressure on the exchange rate of the renminbi, and China will have to change its growth model from export-led to domestic-led. And this is difficult. So it's not sure that China can keep up its growth rates of the last decade. Many observers expect that economic growth will fall down, and not to dramatic low levels. A 6% economic growth is something we can only dream of in the European context, but from a Chinese perspective, it really is a slowdown. What we also see here is the monetary policy. it's very loose. Overall, it's loose. Money is freely available, base money is expanding, central banks are very effective in keeping money very cheap. The problem is, of course, that if you at the same time have loose monetary policy, but on the other hand, fiscal policy tightening all over, a loose monetary policy is not very effective in stimulating growth. So in a context like this, economic policy, it will not be very effective. And finally, emerging markets can support global growth, and they will do, but all in all, they are simply not large enough to sustain a role as a locomotive for the Dutch economy. China is an immense country, and it's impressive what it did, but if you see the average income in China, it still is a relatively poor country. So countries like this have a long way to go before they can take over the locomotive role the US has played, Europe should be able to play when it's in a good shape, but when it's not is today. All in all, a bumpy recovery with some risks ahead. This thing is really slow. Okay, this is better. The short-term risks are the Eurozone crisis. Although we think that we have seen the worst of the last 2 years, you still cannot exclude that things go wrong in Europe and we will face new market pressures in the course of the year. I will come to that later in my presentation. The next short-term risk is, of course, the US situation, where they run from crisis to crisis. It adds to uncertainty, and you cannot exclude that sometimes such things can escalate, can depress the economy, which would be bad news for the whole world economy. So we simply are not there. And finally, we will see a global reshuffling of currencies. Already today you heard about the overvaluation of the Australian dollar. We think more currencies are overvalued. To be honest, I think there's only one currency undervalued, and this is the euro. Which is, I think, bad news for European exporters that hope that the weak euro will help to overcome the crisis. But looking at the fundamentals, I expect a quite major reshuffling on the euro-dollar exchange rate, with a weaker dollar and a stronger euro. I come to that quickly in my presentation. And in the medium term, we have some other risks here. A fiscal crisis in Japan. I will show you a picture later in my presentation which shows that compared to Spain, compared to Italy, even compared to Greece, Japanese public finances are really a mess. And the only reason why the country can continue the way it does is that it's simply the private sector saves so much money and they keep the money in the country, and this time they can prevent a crisis for the time being. But there are many analysts that say in 5 to 10 years from now, we will see a huge financial crisis in Japan with the public finances. And this was really a spectacular one. In China, a hard landing, it is a risk. It's not a forecast, but you cannot exclude that the combination of changing your growth model in a context of changing your political leadership can really translate into a stronger slowdown of the Chinese economy than many people expect. So it also is one of the medium-term risks. And then in the background, we have some long-term trends which will make sure that the world economy will be a very challenging place to operate for the next decades. And first, it's the increase in the world population, from 7 billion people now to 9 billion people in 2050. This is good news for food producers. We think that this will structurally lead to more demand for food and upward trends in prices. So that's the good news. It's good news for you, also good news for the Netherlands, which is one of the major food exporting countries in the world, in spite of its smallness. But it's bad news for the many countries that have low incomes and where people spend more than half of their income on food. If you have food price increases in those countries, it immediately translates into hunger, in poverty, into political instability. And many observers say that all the stability we've seen in the Middle East since 2008 are a reaction on the high food prices in the summer of 2008. So for the world's stability, this is not very good news. The US is turning itself into an energy exporting country, which is good news for the US. They have invested a lot of money in shale gas production. They will be self-reliant on energy in 5 to 10 years to come. They may turn even into an exporting country of energy, which is good news for the dollar and may undermine my medium-term dollar forecast. But it could change the whole global landscape, the political landscape. The moment the US is not dependent on the Middle East for its oil supply, their whole attitude toward the Middle East may change. So that could be bad news for the countries in the Middle East if the US, which always has a isolationistic movement, which is rather strong in the US, should change its attitude there. For example, why spending billions, dozens of billions a year in having a huge Navy fleet in the Middle East the moment you don't need those countries anymore as suppliers. Global warming and climate change, you will hear more of this today, so I will just mention it here. And finally, the global imbalances. 5 years ago, 6 years ago, it was the main theme in economic conferences, the global imbalances. The US, deficit country, other countries, surplus countries, could lead to instability. Well, then we had the crisis, first the financial crisis, 2008, then the euro crisis. So we forgot about the imbalances. But underlying, not that much have changed. So a major source for global imbalances are still with us, and they are called the global imbalances, with the US in an important role. This picture summarizes it very briefly. It shows the current account deficit of the United States of America, and the current account of a country is the savings balance of a country. If you have a deficit on the current account, you spend more than you produce. So it's not only the public deficit which is important, but the current account in the end is the best forecast of problems for a country. For example, Australia has a current account deficit, which is one of your weak spots. But we're talking about the US here. They were more or less balanced in the 1970s, and then cumulative huge amounts in deficits here. And there's only 1 year, 1991, that the US had a surplus in the current account, which was after the first Gulf War, when the Saudis paid the Americans for the military intervention. But in trade, deficit after deficit. And this translates, of course, in a debt position. So the US already is today a country with the blue line with a negative international investment position. It has more debts than it has assets. But the difference is that all those assets the US have are in euros, in sterling, in Japanese yen, Swiss francs, Norwegian krone, whatever, and all their liabilities are in US dollars. So the moment the dollars would halve in value, like it did in the 1980s against the stronger currencies, it would have 3 effects on the US economy. First, it would increase their competitive position, which is good news for American exporters. Next, it would lead to higher inflation. And nobody likes high inflation, but the US is a relatively closed economy, so a weaker dollar could just help to have inflation levels to 4 or 5%, which is very bad news for bondholders, but is very good news for the issuers of debt, the US government. And finally, the US is the only country in the world that becomes richer the moment their currency declines. Because their debt is in their local currency, it declined with them, the foreign assets measured in US dollars mushroom, and suddenly the US can become a net international creditor nation by having their own currency declining. This is why I'm quite sure that in the end the US dollar will decline. It's just a win-win-win situation for the US, and the rest of the world will pay the bill. This time is different. Maybe you've heard of the book written by Reinhard and Rogoff. It's about 800 years of financial crisis. And the title is, "This Time is Different. The most expensive words in history." Every time you have booming markets and people start to worry, are markets getting overvalued? Is this sustainable? And then there always are analysts that say, well, this time is different. The world economy has changed, valuation, things have changed, culture has changed, whatever has changed. And then you know that you're approaching a bubble which is about to collapse. The most expensive word in history. It's a great book. It's a great book. It starts in 1600 or 1500, and it shows that financial crises The moment we have market economies and markets go up and down, you have cycles, and then you have financial cycles, and sometimes those cycles become deep, and then you have bubbles and crises. It's just what market economy are all about. And it's a total illusion that you can have a crisis-free environment. I know today regulators all over the world and governments are very sure this is not going to happen again. Something like with Lehman and something like the Eurozone. And believe me, it will happen again. It will happen again. I know only of one country that never faced a financial crisis. But you don't want to live there. It's North Korea. Is this time different? Yes, it is different, but not in a good way. What you see here is of the developed world, the public debt ratio. So it's more or less on the same level it was briefly after the Second World War. The different thing, of course, it's the first time in peacetime that we have this kind of debt ratios at all. The lesson to be learned by policymakers is that if your economy is doing fine and you have economic growth and unemployment is not too high, you should have your public finances in order. If you don't, you will pay a price. And this price we are paying today in a recession-like environment in Europe, in the US, which still has a weak economy, and actually no country apart from Germany, which refused to act, but apart from Germany, has the firepower to counter the recession, because they all have too much debt and already too deep deficit ratios. I will skip the next slides. You will have the handouts, so it's then you can see more of it, because I want to go to Europe. You see, there's someone that is utterly best to make very nice presentation, and I hate this kind of slides. Europe. What's going on in Europe? I think that I should start by explaining the background of European integration. What happened in Europe was a very bad habit of several countries to go to war to each other every 25 years. It was Germany against France, France against Germany, Germany against England, France against England, England against Spain. If you go back in history and you try to find a period of more than 40 years without war in Western Europe, you will never find one, except since the Second World War. This was the starting point. People realizing after the Second World War, this could be done in a better way. Let's start to cooperate. And if you want to have support for cooperation, people should see that it brings benefits. So let's have economic cooperation. So what we had since 1945, very quickly emanating in the European Union, starting with the European Commission, the community in 1956, it was free trade in Europe, no trade barriers, no protectionism, and currently moving toward a completely developed internal market. And this has paid off enormously. Wealth in Europe is higher than it ever has been. The same can be said about Australia, of course. But in Europe, it has to be in the trade between countries that was the engine of growth that brought us where we are today. The problem we had is that in this internal market, we have several exchange rates. And every country has its own central bank. And some countries just connected their currency to the Deutsche Mark, like the Netherlands. We threw away our monetary autonomy already in the 1970s because we're economically more or less a province of Germany, although we're richer. They beat with football, with we in economics. But other countries had quite volatile exchange rates. And that's led to always the danger of the return of protectionism. I remember a weekend, on Friday there were some rumors in the markets that something might happen, and during the weekend there were some political consultations in Brussels, and on Monday the Italian lira had declined in value with 10% against the rest. The next day in France, union members into the street protesting against illegal imports from Italy, wanting to have measures, trade barriers for Italian cars entering the French market. There always was this threat of protectionism. So it made sense to have a common currency in the euro. This is the good part of the story. And the euro effectively did its job. But what people did not realize is that you introduce a common currency in the eurozone, you introduce a monetary union, you enter a monetary union with one of the most competitive economies in the world, Germany. And Germany really is competitive. So the countries that entered the Eurozone, some of them just, well, were happy to be in, didn't change their policy, and their competitiveness was undermined in the course of the years, and suddenly they faced a problem. And this problem is what we're in now. Before I go into detail, the future, why is this important? It's because the world, the rest of the world, is growing in a much faster pace than the European economies do. Today, you find many European economies among the 10 largest in the world. But in 20 years from now, the situation will change completely. Then we will see that the 10 largest economies in the world, you see the US, still a large major economy in spite of the dollar decline, Japan, China, India, Indonesia, Mexico, Turkey, which will be larger than Germany as a matter of time, and maybe that Germany will be the only European country in the 8 economies in the world, largest economy in the world, but maybe even not Germany. Which means that in the future, a scattered Europe would hardly have any influence on world politics, because if you don't have economic influence, you don't have political influence. And all important decisions about free trade, or democracy, or human rights, or climate change, that kind of stuff, which is really important for us and for our children, would be determined by other powers, and Europe would not be part of it. Together, the Eurozone today is the largest economy in the world. It's larger than the US, it's certainly larger than China, it's the largest exporting unit in the world, the largest importing unit in the world. And in 20, 30 years from now, it still will be one of the 3 major economic blocs in the world. So an organized Europe will have influence. A disorganized Europe will be, well, history. Its influence will be history. So this really is the importance of the agenda, which makes me rather sure that even the generation politicians we have today in Europe, which is not the brightest generation I've seen over the years, yes, is not stupid enough to throw this away. Which is a meager threat for optimism, but well, it still is here. What went wrong in the Eurozone? Actually, it was a naive concept. What they thought, well, we have these countries, they all want to cooperate, we trust each other, we love each other because we're all European, one big happy family, we introduce a common currency, and we have a set of budget rules, and if you have budget rules, and everybody, of course, lives after these rules, we will not have any problems. Which, of course, is madness, knowing that all countries in the world, more or less, have faced financial crisis, banking crisis, public sector crisis. Even Germany, as we all should know, over the last century, certainly 3 times has failed in the public debt. France, Spain, even the Netherlands has failed in its public debt in 1815, which was briefly after the French occupation, so we could blame the French, of course. But all countries has done this. I should still be here. The countries that lived best after the rules. Do you know which country really, really played by the rules in the budget and fiscal policies in Europe? 2 countries stood out, did the best job. Give me a try. Who says Germany? Wrong. Germany was the first country to break the Stability Pact in 2003. They messed it up. Who says Italy? Right. It was Ireland and it was Spain. Ireland and Spain played by the rules in fiscal policy. A superior performance on the public debt. But they had a problem in the property sector, a big bubble, the bubble collapsed, a problem in the banking sector, and the banking sector threw out the government in severe problems. Ireland had a public debt of 25% of GDP in 2008, and in 2009 they had a public deficit of 30% of GDP. So it is, whatever you have kind of rules, you always should be aware that things really can go wrong and you need a framework just for resolution, that kind of stuff. And there was nothing present, and we noticed this when Greece went awry and the smallest economy in the Eurozone messed up the whole thing. This is my favorite picture because it illustrates things that people overlook. What it says on the horizontal axis, it's the public debt ratio of countries. So the more you are to the right, the worse you are. The higher you are, the quicker you go in the wrong direction. That's the deficit ratio. And the larger the bubble, the higher the interest you pay. And then of course here you see Japan, which is way out of line. Well, already discussed this, so I will come here. But here we have the UK, and the UK is my favorite country. I love the British. I love their beer, I love the people, I love the language. I go there very often, but they're fun. They really are fun. I was 2 years ago, I was invited on Bloomberg Television in London to discuss the outcome of a poll about sterling and the euro. There was a poll among the British population, and 65 or 70% of them said, we don't want to join the euro. And this is big news in England. And they invited me to comment on this. So I was in the studio, and first there was an economist from a UK bank, and said, well, this underlines all the major problems in the Eurozone. And then they asked me my opinion, and they said, well, this is the best news I heard about the euro for a decade. What do you mean? I said, well, look at your own ratio here. If you would be a member of the Eurozone, you have quite a large economy, and you would have been one of the weakest in terms of public finances. So you would be a major problem. You will cost us a lot of money. So thank you for staying out. Please stay out for a decade or more. This was not what they expected. They didn't like it, and I didn't get a second invitation. But it's true. It's true. What this picture shows you, for example, also, that Italy, everybody is saying the Italians are mad. And of course, it's a strange country, kind of like Silvio Berlusconi. In any other European country, the guy would be in jail. In Italy, they vote for him as prime minister if they get a chance. So it is a strange country. But economically, it's not a weak country. North Italy is the most developed part of the European economy. Strong industry, high productivity, extremely wealthy, comparable only with the southern part of Germany, Bavaria. It's a very strong part of the economy. The south of Italy, we know the culture there since we saw the movie The Godfather, and everybody's in the movie. It's a strange country, but it's not a poor country. Their public finances, their debt ratio is too high, but their deficit is below 3% last year. In England, it's 2.5 times as high. So the country, it's not a high-growing country, but at the same time, it's a wealthy country. And they have this public debt, it's all in domestic hands, or a large part in domestic hands. The Italian government will never fail in its public debt, because then you fail in your electorate, and that's not a clever way to try to win the elections. And secondly, you're failing on the assets of the mafia, which is dangerous. So they will never fail on their public debt. Other countries here, Spain, we think that, and this is what you read in the English press, in Southern Europe they mess it up, in the North they're doing relatively fine, but they're stupid that they keep the euro. I think the country which is reforming in the fastest speed is Spain. They reformed the labor market, they reformed the pension market, they increased productivity, they are exporting now. Ireland, for example, a country which also ran deeply into problem, in 2 years' time, they improved their competitiveness with 20%. 20% decrease in unit labor costs in Ireland. They're growing again, they have access to the markets again. Things are moving extremely rapidly in the south of Europe. Even in Italy, things are not as bad as they look. Greece, of course, is the weak spot. Greece never should have entered the Eurozone, would have been better for us, would have been better for the Greek, but they entered. We know that they lied since 2003, but nobody thought it was important. Now we know better, but now it's too late to kick them out. How much time do we have, Mr. Chairman? Just to wind up. Okay. This picture shows you what's happened to the stress in the Eurozone after the European Central Bank had a new president, Mario Draghi, a former investment banker who understands the game. Since Draghi has entered, the European Central Bank has entered very innovative monetary policies. First, we have the long-term refinance operations, which was good stability in the banking sector. And then we have the outright monetary transactions, and we say, wow, this is innovative, and this is dangerous, so speculators against the euro, they start to withdraw, and you see the situation normalizing. Without the ECB spending one single euro in the process. It's just that they are credible and markets fear Draghi, and they better do. So what will we see in the near future? This illustrates, you see the peak there, that's Ireland, unit labor costs in 2 years' time, what they did. But also even in Greece, they have decreased strongly. So it's moving in the right direction, and you see that the current account imbalances in the Eurozone are retreating. My last 2 slides, very briefly. What should happen in Europe? We should improve the institutional framework. And a part of this should be a resolution framework. Because you cannot deny, if you want to have a monetary union which will be with us for the future, then you need to take into account that from time to time countries may fail. Like states in the United States sometimes fail without endangering the existence of the US dollar. It's this that you have to get used to it. The Euro Central Bank has about more time, but now the politicians should deliver, and I think that they will in the second half of this year. What can we expect? A further deepening of fiscal coordination, which already is into place. What you also may expect is something of consolidation of financial market, the end of fragmentation. So my Eurobond proposals of almost 23 years ago today are relatively popular, and maybe I will see them materializing in the near future, which will be great fun, of course. Challenges, will there be a Greek exit? I don't think so. It would not be good for Europe, it would not be good for the Greek, but at the same time you cannot exclude it. In Greece they really have a crisis. They see purchasing power declining with 10, 20, 30% in a couple of years' time. It's incredible what they're going through, so the political climate there is very anti-Europe, and you cannot blame them. The people that messed it up have their kind of money in Switzerland, have fled the country, and the people that stay behind are paying the bill. So politically, there still is a chance that the Greek will exit the Eurozone, but at the same time, people get used to the idea. So the contagion effects will be much smaller than it would have been a couple of years ago. About the UK, I said enough, and finally, I'm very, very sure the Euro will survive, even maybe in a slightly moderated form, but the Euro will be with us for the decades to come. Thank you very much.
Thank you, Wim. That was a really lively presentation, and I'm sure we got a great deal